Hello, friends. If you are 65 or older and you ever handle cash, selling a vehicle, receiving a family gift, paying a contractor, or moving money you kept at home, there is a $10,000 reporting rule that most seniors misunderstand, and the misunderstanding is not what you think. The dangerous part is not depositing more than $10,000. The dangerous part is trying not to. One split deposit with perfectly legal cash and a routine bank report becomes a federal structuring problem. Once that pattern crosses $100,001 in 12 months, the statute hits an enhanced penalty tier of up to 10 years. None of this gets explained at the counter. The people who get hurt are not criminals. They are retirees who thought they were being careful. Hello, friends. Grab a pen for this one, because every section I am about to walk through describes something a real person did with their own legitimate money and turned a normal day at the bank into a legal problem they did not see coming. Mark the parts that sound like something you or someone you know would do. Selling a truck for cash, paying a contractor out of savings you kept at home, moving a family cash gift into your account, taking a withdrawal to cover a big repair. If any of that sounds familiar, at least one section in this video was made for you. Now, I track cash reporting rules, federal statutes, forfeiture procedures, and filing requirements full-time so you do not have to. The rules in this area do not explain themselves, and public rumor about the $10,000 threshold is often worse than silence, because the rumor tells you to do the one thing that actually creates risk. The people subscribed here find out in time. Subscribe now and let's get into it. Before we go further, I need to address something, because people hear a topic like this and immediately sort themselves into one of two groups. The first group is comfortable, decent savings, paid off home, and they figure cash reporting rules are for criminals and cash businesses. That is not about them. The second group is on a fixed income, careful with every dollar, and they have heard for years that depositing a large amount of cash will bring trouble. They assume the safest move is to stay quiet and stay small. Both of those assumptions are wrong about at least one section I am covering today, and on every single one, I will tell you exactly which group it helps most and why. Here is your roadmap. I am going to cover what the $10,000 cash reporting rule actually is and what it is not. Then the one action that turns a normal cash event into a federal structuring issue. Then how banks actually monitor activity and why the number you are afraid of is not the number that matters. Then what happens when the government ties up your money and how fast the clock starts. And the last section is the one I want you to pay closest attention to, because it is the one sentence that keeps a normal cash deposit normal. Stay with me through all five. Number 1. The report itself is routine. Here's the misconception that starts every problem in this video. Most people believe that depositing more than $10,000 in cash is illegal, or that it automatically triggers an IRS investigation, or that the bank is going to call somebody. None of that is true. The rule is simple. When you make a cash transaction of more than $10,000, the bank files a report. It is called a CTR, Currency Transaction Report. In plain English, a routine government form that the bank fills out, not you. The bank files it with FinCEN, which is the Treasury Department's Financial Crimes Enforcement Network. You do not sign it. You do not submit it. It is the bank's obligation under the Bank Secrecy Act, and it has been the law for decades. Here is the part most people get wrong. If you walk into your bank with $11,000 in cash from selling your car, and the bank files a CTR, nothing bad has happened. That is a normal, documented, legal transaction. The report is not an accusation. It is not a flag. It is paperwork. And there is an aggregation rule you should know. If a bank handles multiple cash transactions by or on behalf of the same person in a single business day, and the total exceeds $10,000, the bank is required to aggregate those and file a CTR anyway. So the idea that making 2 trips in one day keeps you under the radar, that is already wrong on day one. Now, who does this help most? Both groups. If you are on a fixed income, this is the section that should take the fear out of a legitimate deposit. If you are comfortable, this is where you stop assuming the rule is only about shady cash. It applies to everyone equally, and a clean $11,000 cash deposit is still just a clean $11,000 cash deposit. Your action step is the simplest one in the whole video. Make the legitimate cash transaction in its natural amount. Walk into your bank branch and use these exact words. I have one legitimate cash transaction for this amount, and I want to handle it correctly. I understand the bank may file whatever report the law requires. That is it. One sentence, one trip. That is number 1. That was the harmless part. The next part is where people talk themselves into trouble. Number 2, the crime is trying to stay under the line. Here is the misconception. A lot of people, and I hear from retirees about this constantly, believe that splitting up a cash deposit is the careful, responsible thing to do. You have $12,000 in cash, so you deposit $6,000 today and $6,000 tomorrow. You think you are being smart. You think you are protecting yourself. You are not. You are describing the federal definition of structuring. The statute is 31 U.S.C. section 5324. In plain English, it is a federal law that makes it illegal to break up cash transactions for the purpose of avoiding the bank's reporting requirement. And here's what catches people off guard. Structuring can involve transactions in any amount. It can happen at one bank or across multiple banks. It can happen on one day or spread across many days. And it is illegal regardless of whether the money itself is legal or illegal in origin. Read that part again. You can have perfectly clean, legitimate cash, and the act of splitting it up to dodge the report is its own separate violation. This is the section that helps the fixed income group most, because you are the ones most likely to think smaller deposits are safer. They are not. You took a normal $12,000 cash event and made the pattern itself the issue. The money did not change. Your intent, or what a prosecutor could argue your intent was, did. Now, the statute does require purpose. You have to be splitting the transaction to evade the reporting requirement. The script is not telling you that two small deposits are automatically a felony. But here is the problem. If the pattern looks like evasion, the burden of explaining yourself shifts to you. And I heard you're not supposed to go over $10,000 is not the explanation you want to be giving. Your action step. Do not split a cash transaction to stay under the threshold. Keep the bill of sale, the withdrawal receipt, the estate paperwork, or the gift documentation. Walk in and say, "Please process the transaction as it actually occurred." And if anyone, a friend, a family member, a well-meaning neighbor, tells you to break it into smaller pieces, understand that they are telling you to do the one thing the law was written to punish. That is number 2. And here is what makes it worse. The number you fear is not the same thing the bank is looking for. Number 3. The pattern is the danger, not the number. Now, everything I have covered so far was about the $10,000 threshold, the routine report, and the mistake of trying to dodge it. This next section changes the picture, and I need you to hear it carefully. Banks are not told to panic at $10,000. They are told to watch for suspicious activity, and those are two very different things. The bank's other reporting tool is called a SAR, Suspicious Activity Report. In plain English, a separate form the bank files when something looks off, and it has nothing to do with the $10,000 line. Here is the fact that surprises the comfortable group most. A transaction at or near the $10,000 CTR threshold is not by itself enough to require a SAR. What triggers a SAR is behavior that looks like someone is trying to avoid scrutiny, and a SAR can be filed within 30 calendar days of initial detection, or up to 60 days if no suspect is initially identified. So think about what this means. 4 deposits of $9,500 are not 4 safe deposits. That is a $38,000 pattern, and every one of those transactions sits just below the reporting line. That is not safer than one honest explanation. That is the shape of evasion, whether you meant it that way or not. A man I heard from had done exactly what a lot of retirees think is the cautious thing. Ron, 72, retired machinist outside Dayton, Ohio. He sold a classic pickup truck for $18,500 cash. He had heard for years that depositing over $10,000 triggers the IRS, so he made 2 deposits, $9,250 and $9,250 on consecutive days. He thought he was being careful. What he actually did was take an $18,500 transaction that would have generated one routine CTR and turned the whole amount into a pattern that looked like textbook structuring. The right move would have been 1 deposit with a bill of sale, 1 trip, 1 report, no issue. And to put the scale in perspective, IRS Criminal Investigation reported that 94% of its fiscal year 2025 cases were searched against Bank Secrecy Act data, with more than 3.9 million searches. The system is not guessing, it is reading patterns at scale. Your action step: never ask how to avoid a CTR. If the bank asks about the source of your funds, answer truthfully and briefly. Use these words: "The source is," and then name it, "and I have records if you need them." That is all. That is number 3. If that sounds abstract, the next section is where it gets expensive. Number 4, when the money itself gets tied up. Here is the misconception that costs people the most time and the most sleep. A lot of retirees believe that if the money is theirs and the source is legal, the government cannot touch it. That is not how civil forfeiture works. Civil forfeiture is a legal proceeding against the property itself, not against you. In plain English, the government does not have to charge you with a crime to seize your cash. The forfeiture case is separate from and does not depend on a criminal prosecution. That distinction matters because it means the clock starts whether or not you are ever accused of anything, and the clock is fast. After a seizure, personal written notice must be sent as soon as practicable and no later than 60 days after seizure. That notice gives you a claim deadline of at least 35 days from the date it is sent. If personal written notice is not received, published notice must give you at least 30 days from the date of final publication. So from seizure to deadline, you could be looking at barely more than a month to respond. And if you miss that window, you may lose your ability to challenge the forfeiture entirely. Now, who does this help most? Both groups. Whether you are on a fixed income or sitting comfortably, a seizure notice with a 35-day claim deadline does not care about your net worth. It cares about whether you read the notice and responded in time. And here is the part that should make everyone in both groups pay attention. The Treasury Inspector General for Tax Administration, TIGTA, reviewed 278 structuring investigations where the source of funds could be determined. They found that 91% involved legally obtained funds, not drug money, not fraud, legal money, from people who handled it in a way that matched a structuring pattern. And in 2016, IRS criminal investigation began notifying about 1,800 property owners to petition for return of funds that had been seized. Think about that. 1,800 people, most of whom likely had legitimate cash, going through a federal process to get their own money back. Now, IRS criminal investigation did change its policy back in 2014. They said they would not pursue seizure and forfeiture in solely legal source structuring cases unless there were exceptional circumstances and high-level approval. And the Taxpayer First Act brought additional limitations, so the landscape has shifted. But civil forfeiture authority still exists, the process still moves fast, and the deadline pressure is real regardless of policy changes. Let me put a number on it. Say the amount at issue is $24,000. That is a home repair. That is a used car and a contractor payment. That is not a fortune. But miss the wrong line in that forfeiture notice, and a $24,000 problem can become a permanent one in barely more than a month. Your action step. If property is ever seized, read the claim deadline line first, before you do anything else. Check the notice at forfeiture.gov. The two questions you need answered immediately are, what is my claim deadline, and where must a claim be filed? Do not wait for the confusion to pass. Do not assume someone will call you. The notice is the clock, and it starts whether you open the envelope or not. That is number 4. Now that you know the risk, the last part is the simplest fix in the whole video. Number 5. The SAFE framework. Let the report happen, document the source, and know about Form 8300. This is the section I told you to stay for, and it is the easiest one to act on. The misconception behind every problem in this video is the same. The smart move is to avoid every report. It is not. The smart move is to let the routine report happen and make sure your records are clean. Here is the framework. Step 1. Make the cash transaction in its natural amount. Do not break it up. Do not ask the teller how to stay under the threshold. Do not let a friend or family member convince you that smaller is safer. Step 2. Keep your documentation. If you sold something, keep the bill of sale. If you received a gift, write down who gave it to you and when. If you withdrew cash for a contractor, keep the receipt. Step 3. If the bank asks about the source, answer truthfully and move on. That is the entire framework. One transaction, one set of records, one honest answer if asked. Nobody at the bank coaches you through this. The CTR does not come with an explanation. The teller is not going to stop you and say, by the way, there is no reason to split this up. The system records the transaction either way, and the misunderstanding falls on you. Now, there is one more rule in this area that catches people who are not just depositing cash, but receiving it in a business or side work context. It is called Form 8300. Any trade or business that receives more than $10,000 in cash in one transaction or in related transactions is required to file Form 8300 with the IRS and FinCEN. The filing deadline is 15 days after the cash is received, and the business must send a written statement to the person named on the form by January 31st of the following year. If you do any work on the side, selling goods, doing contract work, anything that counts as a trade or business, and someone pays you more than $10,000 in cash, this form applies to you. And here is a detail most people would never guess. The IRS says businesses may voluntarily file Form 8300 for suspicious transactions even below the $10,000 threshold, and they highly encourage it. So the $10,000 line is not a safe harbor. It is a floor, not a ceiling. Someone in the comments described this exact fear. Elaine, 69, a widow in Mesa, Arizona, former school secretary. She needed to pay roofers $24,000 in cash and was terrified that one large withdrawal would set off alarms. So she made several smaller visits to the bank over a couple of weeks, pulling out a few thousand each time. She thought she was being discreet. What she actually did was create a withdrawal pattern that looked like textbook structuring, for the exact same $24,000 she was going to spend either way. The right move would have been one documented withdrawal, receipts from the contractor, and no threshold dodging behavior at the counter. The dollar amount did not change. The risk she created was entirely self-inflicted. Who does this section help most? The fixed income group, because you are the ones most likely to feel nervous about a large cash transaction and most tempted to break it up. But the framework works for everyone. One natural transaction, records of the source, an honest answer if asked. That is it. And here is the number that puts the ceiling on this whole topic. Once a structuring pattern crosses $100,001 in a 12-month period, the statute moves into its enhanced penalty tier, up to 10 years. But the easier win, the one within everyone's control, is never creating the pattern at all. That is number 5. So here is the full picture. The routine CTR report for cash transactions over $10,000. That is normal, and it is not an accusation. The split transaction that turns a clean deposit into a structuring pattern, that is the real danger, and it applies to legal money just as much as illegal money. The suspicious activity review that is not about the number alone, but about the behavior. The civil forfeiture process where the clock starts fast and the deadlines do not wait. And the one clean framework that keeps legitimate cash looking legitimate. One transaction, documentation, and honesty. The bank does not coach you through the rule. The report does not explain itself. The government does not pause the deadline because you were confused. The forfeiture notice does not wait for you to calm down. And no one at the counter is going to save you from a rumor you heard 10 years ago. Being allowed to move your own money and moving it in a way that stays legally clean are two different things. The gap between them is information, and that is exactly why this channel exists. Now I want you to think of one person, a parent, a neighbor, a friend over 65 who still deals in cash, for cars, for contractors, for estate property, for family help. Share this video with that one person, not because they are doing something wrong, but because a lot of honest people still believe the safest move is to stay under $10,000. And that belief is the one thing in this whole video that actually creates risk. Subscribe, share this with someone you know who handles cash and wants to handle it the right way, and I'll see you in the next one.